Welcome to our January edition of Market Happy Hour. My name is Kevin Ergel. I'm a partner and portfolio manager here at Capital Wealth Advisors. I run one of our 4 equity strategies. We're going to go through a topic of inflation today. And before we get started, it's worth noting that our attorneys do get paid by the word. So as you can see, a fairly lengthy disclaimer here. We are asking everybody on this Zoom meeting to not record any audio or video from it. All right, with me today, I have Lewis Johnson, our Chief Investment Officer, and Zev Abraham, our Director of Research. All right, as we go along, you will see in the upper right part of your screen, it really depends on how you have your Zoom configured, but you can submit questions at any time, and we will answer as many as we can at the end of the presentation. As questions come in, if we're tracking well on time, I will try and get to those. Typically, they will come in during a topic that we're on. So I will try to interject those as we go throughout. If we do not get to your question that you submit, we do follow up via email and we will get back to you. And at the end, we ask that you complete a survey. Let us know how we can improve this event for you on a go-forward basis. All right, so Lewis, what we're going to discuss today is inflation. And I believe everybody should recall from their Econ 101 class, the basic definition of inflation is too much money chasing too few goods and services. And so I think it's safe to say most people are looking in the rearview mirror and looking to, say, February, March of 20, when central banks decided to airdrop several $1 trillion on the global economy while shutting down production globally. So what possibly could happen in that environment? And now this is top of mind for everyone, and it certainly is running its circles within the media. So as you take us through our inflation expectations and some key metrics that we're looking at, I'll let you go ahead and start.
No, that's great. Well, thanks, Kevin, and again, welcome everybody, and thanks for taking the time to kind of chat with us and hear the kind of things that we're worried about, kind of peek behind the curtain in terms of our research process. We always appreciate the time that you devote, so thank you very much. So we thought we'd talk about inflation today. Certainly it's very topical, as Kevin was noting. There's no question that we've experienced some of the highest CPI inflation since 1980. But, will that continue? Because one of the things that's most important to us in the financial markets is really not what's already happened, but what may happen in the future. The market's definitely a discounting mechanism. So we'll talk a little bit about things we're seeing, why we think some of these pressures may be starting to ease in the next kind of 2 or 3 years or so. We don't think they're going to be here with us on a sustained basis. So that's a little bit of the punchline, but we'll talk to you a little bit about why that is. And a couple of points we want to make is that even though people may think of, let's say, the 1970s as another time where you had this high CPI inflation, there was also a period of high inflation we think is a little bit more appropriate in terms of how we think the market might respond. And that's really, say, the 1940s market, which people may not be as familiar with. So we'll talk to you a little bit about that as an example. We love to learn from history. And then we'll kind of pull all this together, talk to you a little bit about some of the things we're excited about, some of the things we're watching with concern, and kind of how we've always had the view that there's always kind of a bull market somewhere, and our job as a research team is to try to find those interesting ideas and invest in them, and we think they are out there as they are in every market. So that's kind of what we'll talk about today. So the first is in terms of inflation, what's the definition, how to think about that, and I can tell you, Zev and I are a bit of not on the subject after knowing him for more than 20 years. And I can tell you that literally half the books I have in my kind of library are focusing on, these periods of kind of price disorder. But, in all those books that I read, I think the best example that I've ever come across in terms of, what inflation kind of actually came from 1810. It was, of all things, a House of Commons subcommittee that got pulled together in 1810 because the English were fighting battle to the death with Napoleon, of course, on the continent. And what they found is that there was very much monetary disorder. People were complaining. And so they did a deep dive to try to figure out exactly what happened. So it's a fascinating book. It's a couple hundred pages, I think. They interviewed, it's verbatim testimony for the people that came in front of the committee. So it's a fascinating read. You can't have my copy, but it's great. You should get one if you can find it. But there were two, and so the conclusion of all that was that there are two things, in the definition of inflation could be captured in two ways. The first was a rising price of gold in the local currency. And the second was that the local currency was weak relative to other currencies. And frankly, on that definition, we're not kind of having a generalized inflation at this point, because the dollar is actually up about 8 to 10% versus a trade weighted basket of other currencies. And the gold price, and we're very bullish on the gold price, but it still is frankly flat for like the last 18 months. And actually it's the same price it was 10 years ago. Under this traditional definition of inflation as we see it, there's unquestionably been price increases, but we don't think it's the kind of systemic inflation that came from the 70s. And we'll talk a little bit about that. We think really one of the biggest factors that perhaps are factoring into how we're thinking about investing is really the shock of deglobalization. Because remember, this whole idea of just-in-time inventories to increase the return on equity of companies by having less and less cash tied up in the business led to this wonderful optimized schematic where frankly there was one big plant, in China that was the lowest cost, and they would export that all over the world. Well, that model kind of died with COVID. And particularly with the kind of continuing fallout we've had in relations between our two countries. And so we think that really this COVID shock took a weak kind of deglobalizing system that frankly we've been writing about since 2016 with the rise of Brexit and the shattering of the European Union, to basically what we've seen through COVID. So these are very real, and they're definitely resulting in price increases, and they are fundamental. But we think they're different forces than, let's say, the 1970s type inflation. A couple of other items that we'll talk about. There's been a lot of talk in the investment community about these environmentally and socially conscious or environmental and governance issues that try to add a whole nother layer of complexity onto the traditional idea of investment analysis of trying to buy the right securities and so forth. There's more of an idea that whether it's climate change or things that society wants to change, that these need to factor more in the investment program. The reason this is starting to, we think, kind of gum up commodity markets and should lead to higher commodity prices in many extent is that this is really weakening supply growth. The hydrocarbon industry, like oil and natural gas, very valuable commodities that we need to power the world every day. And right now, the markets are heavily disincentivizing those producers to kind of grow supply. And in my business of analyzing supply and demand, when you curtail supply and demand stays pretty robust, all you do is you get higher prices in the future, which is kind of what we're seeing right now. And it's our expectations for the future. So we'll talk a little bit about that. And also some of the volatility in terms of the tide coming in and out. Like one of the things that we showed, just a funny little story here, of course, you see the image in front of you. It's one little toilet paper roll. I mean, I think all of us during COVID got introduced to this idea that you could walk into the grocery store and be shocked that the shelves would be empty. But the point I'd like to make about what happened in toilet paper is I would submit that the demand for the underlying drivers of toilet paper did not, in fact, go up. It was just that people saw that there were empty shelves. Didn't want to run out, and so people hoarded. And so this concept of inventory hoarding and dishoarding is something as a cyclical investor I've dealt with for the last 22 years of my career. And so I think that this has been a powerful part of creating shortages in these very fracturing and delicate supply systems. So there's a lot of stuff going on, and we do think that it's real, but we think it's kind of different from the traditional definition of inflation.
Louis, if I could just take 1 second and interject when we talk about ESG, and that's also something that's very topical. And we'll have a number of our investors will ask us why energy is doing so well. And especially when we're getting off of hydrocarbons and fossil fuels. Is it safe to say that our efforts to remove the reliance on these fossil fuels, there is a tax that we're paying right now, and that's in the form of higher prices?
That is an excellent point, Kevin. And frankly, I think a lot of the elites or the leaders who have been pushing these as socially justifiable, they kind of forgot to tell consumers that what this meant is that the price of these things would go up a lot. And so this is totally happening right now. One of the perfect examples of this, just on Friday, basically, France essentially nationalized EDF, which is its largest publicly traded electrical utility. That basically the government was afraid of the populist backlash that they would have to deal with, because average electricity costs were going to go up 50%. And basically what the government didn't want to deal with that. So the government of Macron, who is up for election this year, I believe, basically mandated that that the utility company had to, by law, sell electricity at a loss. So the stock promptly lost 25% of its value. So, that's not strategy, forcing your publicly traded utilities to do non-economic things to avoid the backlash from your misguided policies, even though they have a nice intended consequence. That's inefficient. The market's basis has been the efficient allocation of resources. It's the most amazing problem-solving vehicle ever created by man. And frankly, I think that the more that these non-economic items get added to it, I think the less well it's going to function. And as a cyclical investor, I think what this means is more volatility and frankly, more opportunity to have higher commodity prices for a longer period of time. This is the way the world works.
Thank you, Lewis.
All right, next slide, please. Okay, great. So here, what we wanted to talk about is one of the aspects that we were highlighting, that we really think that even though interest rates, we're at an early period of these can rise, we really think that people need to study history and be circumspect for kind of how high interest rates can go. And so that's kind of one of the chief takeaways that we're grappling with in this chart. So what we demonstrate in this instance is kind of two things. We show the broad trend in 30-year bond interest rates in that kind of red line, where we demonstrate that interest rates were rising from early 2018 to kind of late 2018, and then they began to fall pretty materially. And one of the things that was also falling during that time was the blue line, which is the S&P 500. And so what we believe that this demonstrates is that essentially there was a price of money represented in long-term interest rates that got to be too high for the market to be able to kind of process that in a way that wasn't deleterious to the economy. So, and I think if we can advance maybe one more, I think we have this demonstrated in terms of changes and what this green line demonstrates is what the Fed was doing with interest rates at that time. Because you may recall that the Fed was underway with one of its interest rate hikes, interest rate hiking cycles, and that they continued to raise interest rates even until late 2018, early 2019, even though the market in its wisdom had started to take those 30-year interest rates down. And basically what I think this demonstrates is that the Fed kind of erred in over tightening, and that they basically took the price of money too high. And in my opinion, an over indebted economy, which I believe we're in, we'll talk about that, cannot take a kind of high and rising price of money. And I believe that relationship will be true at the next cycle. And this is a big reason that why we definitely are experiencing kind of higher inflation right now. We do have a sanguine outlook on bonds, because we think a lot of this pressure is end up going to be more short term. And we'll talk about that in a minute.
And Lewis, isn't it worth noting that at the end of this tightening cycle in 2018, since 2009, 2018 is the only negative year in equities, which the market, S&P 500 was down a slim 4.4%. And I say that to illustrate the end of the tightening cycle, but also how long this bull market has gone on, and literally 11 out of 12 years at this point.
Yeah, no, that's a great point, Kevin. It is remarkable. And one of the things that we'll talk about in a minute is that, of course, we've enjoyed one of the biggest bull markets in history. The bad news, I suppose, about that is part of that outperformance has come through higher valuations or paying more for the same stream of earnings. And this creates an ever riskier market as that valuation gets higher. So it's the price of success. It's been fun on the way in. It may not be so fun on the way out.
We should also recall that Jerome Powell changed his position from tightening to loosening in I believe it was a period of a day or two after that last green line hike there, as the market fell to minus 20%. All of a sudden he changed his tune, and I think that's something that we should be aware of going forward. If the market gets weak, the Fed is probably going to change its tune quite rapidly.
No, that's definitely the way that happens. I think what I would also suggest, like one of the things we're going to talk about is kind of the slowdown underway in China, is that there's some times when the Fed can cut interest rates, and when the tide's going out, it's just simply not enough. Those of us who were active in the markets in 2007 and 8 remember that there was a couple of days where the market greeted the first Fed interest rate cut, which I think was August or September 2007, with great joy, and the market went on to a new high. Of course, market would fall 50% from there in a bloodbath of a downturn in the worst financial crisis since the Great Depression, because the down cycle was too entrenched. So there's what the Fed tries to do, and then there's what ends up happening with the cycle. And sometimes the cycles are bigger than the Fed's. Next slide, please. Great. So one of the reasons, and frankly, if you haven't seen this in our kind of research, please reach out. We'd be happy to share some of it with you, because really it's been the key theme, I think, that we've been hammering away at the most consistently since we started publishing in 2014, which is our view that the world is over indebted, and that we believe that over indebtedness drives an imperative of kind of falling interest rates. And so what we're highlighting in this instance with these red circles, is that the last time that CPI inflation was as high as it is right now was basically 1980. The point we're making here is that when Paul Volcker came in as a very famous and aggressive Fed chairman who took short-term interest rates to 20%, which broke the economy and kind of broke the back of inflation. This shows federal debt to GDP at basically 30%, which is about 70 to 80% lower than it is right now. So debt to GDP is up, 4 or 5-fold since then. And frankly, this is just federal debt. We could show you, total debts, and it would show you the same pattern. So the point we're trying to make is that that interest rate behavior in terms of the authorities in the market in general has to be cognizant of the fact that total debts to GDP are up, 5 or 6-fold from the way they were. The interest rate policy that worked then, the higher yields that could prevail then, after decades of shrinking debts, are completely different from the world that we have to live in right now.
Louis, is it worth noting that there are periods of time in our economy where it expands and debt to GDP is not growing? As an example, during the Clinton administration of '94, we see that we had great economic expansion and debt to GDP was falling during that time frame.
No doubt. I guess, and this perhaps is my speculation, although I think the empirical data seems to back this up, Kevin, that I believe that with the global financial crisis in 2007, it was kind of the breaking of the normal functioning of the private credit system. And essentially it went on federal life support, because that's when these quantitative easing campaigns began. And so basically the Fed has kind of had its fingers in the financial system ever since. And I think that we had a freely functioning financial system that was allocating, credit along one basis. And then when it wasn't working, the Feds got involved. And that's the reason that the debts kind of really started kind of hockey sticking growth-wise, is that, they weren't content with the functioning of that system. So they decided to get active in it.
Yeah. Would you say that people have become comfortable with the notion that federal debt and debt levels don't matter, and there's some complacency around it?
Well, it can be a highly charged emotional decision. I mean, empirically, it hasn't seemed to have mattered yet. Although one of the things, I don't have it here in the chart deck, but one of the things that I've shown that's pretty scary, frankly, for at least tax-paying people like myself, is that there's an exceptionally strong correlation with debts to GDP on a government basis and tax levels, right? And so what we've seen so far is we've enjoyed higher debts to GDP while interest rates have fallen. But the long-term track record is that the higher debts go, it leads to higher taxes. And as a person that pays my own taxes, I'm not a big fan of that. But it's one of the things that happens. And frankly, higher tax rates are one of the fastest ways to slow the economy. So I'm dreading that moment. Great. All right, so we need to take a couple of minutes and talk about this slide. Looks kind of busy. In my opinion, this is the most important thing we have to talk with you guys about today. So just let me take a couple of minutes and kind of walk you through it. So this data begins in about 1870, 1880, of course, goes to now. So it's a great long-term time series. I love history. It's a wonderful way of looking at it. And what it demonstrates is something called the CAPE ratio. This is a cyclically adjusted PE ratio. So basically what this does is it takes a look at inflation adjusted earnings kind of over a 10-year period and looks at current stock prices on that kind of rolling adjusted 10-year period. So essentially it's just a way to normalize and look at a very long time at these PE ratios. So one of the things that you can see, there's a couple of peaks that were pretty high. We're at another peak right now. And those frankly were the peaks of historic bull markets that frankly turned into bear markets once the valuation stopped expanding. And these are, kind of famous bubbles, essentially. 1929, the cyclically adjusted PE ratio was 32.5. Then fell apart in 2000, kind of when, in the early days when I began my career as a young analyst at T. Rowe Price, was the highest cyclically adjusted PE ratio kind of ever. During the tech bubble, I never thought I would have to endure that again as a professional investor after starting my career like that. And here we are again. So now below that, I want to demonstrate a couple of things. So first, we have a table that takes those peak CAPE ratios and it converts into something called an earnings yield. So when an earnings yield is simply just the inverse of a PE. So for instance, if you had a stock with a PE of 20, what it means is that your earnings yield on that is 5, right? So that's essentially your earnings that would be coming to you as the shareholder. So it's not the dividend it pays out. It's really simply the inverse of the price to earnings ratio. And so what we highlight in this instance, you can see that when you have these very low earnings yields, essentially what you're saying, you have a high PE ratio. And then we show subsequent equity returns from there in the table below. And what we show is that from these exceptionally high and historically high valuation levels, equities were exceptionally poor investments in general. And that was really just due to the normalization valuation. And so this is what I meant from earlier saying that, as an investor, when you're in these markets and you're getting paid an ever and ever higher price for the same earnings, or maybe earnings growing a little bit, that's wonderful on the front end. The problem is that at some point, it means that the investments that you may own or the market in general is very highly valued, and there could be quite a bit of downside should fundamentals normalize. And this is one of the things that is very much on our mind as a research team and as risk managers and fiduciaries, as we're definitely enjoying the increase in markets, but you have to realize that one of the factors driving this is valuations, and that's wonderful on the front end and it's deadly on the back end. And just to demonstrate, again, if we were refer to that chart at the bottom, for instance, we show, for instance, 3-year returns from that ultimate peak in that CAPE ratio when the earnings yield was low and the PE was high. So for instance, from the 29 period, equities declined 84%, which is a devastating loss over that time period. The 1999 peak, 43%. And of course, what the future holds for us right now, we kind of don't know. We're definitely at historic high numbers. Maybe it gets even higher. One of the things that we spend a lot of time doing as a research team, as risk managers, is trying to focus on, long-term returns and on reducing risks when valuations are high. So this is factoring into, why we continue to embrace bonds, as very favorable investments, even though, the history, as Kevin says, recently has been one that's been problematic for them. We think the future is different. And it's also why there's one other point that we want to make here is that we're embracing kind of investments that help us diversify portfolios. And so this is the last point I'd like to make on this slide. If you go to those peaks, for instance, you see those 2 boxes. One has the 1999 peak. What we show there is what the gold price did in the 5 years, excuse me, that followed that very high peak in equity valuations. And in both the 1929 case and the 2000 case, gold and gold-related investments were wonderful diversifiers. Gold in both instances, frankly, was up 65% over a 5-year period. So the point we're trying to make here is twofold. The first is that, we do think that the very high valuations in the market right now present a risk. And so we're actively trying to manage that by owning different equities, say that in the market, and having a diversified portfolio. And one of the ways that we can do that is really that there is opportunity, I think, in all markets. And in this instance, we think that gold and other kind of precious metals in particular, we think are wonderful diversifiers and frankly, very timely for us to own at this point.
Louis, could you take a moment and explain earnings yield at the bottom?
Sure, Kevin, thanks for the question. So if you look at the bottom, remember this is the bottom left right after market period. So what this earnings yield demonstrates, remember, it's simply the opposite of PE. So if a PE is, for instance, 50, you just you divide that by if you take the P of 50, then the earnings ratio, the earnings yield is 2%, right? Because if you're paying a P of 50, so you're paying 50 times earnings to own a security, it means that the yield and earnings you're getting every year is 2%. So essentially, the lower that earnings yield is, it means the higher the price to earnings ratio is, and the more highly valued security is. And remember, go ahead.
I was going to say, so kind of a visual or mathematical way of looking at this is the price divided by earnings gives you that PE
exactly.
ratio that we hear. In this case, we're taking earnings and dividing it by price.
Yeah, no, exactly, Kevin. And of course, what we're trying to demonstrate with that is it's great fun when you own something and it goes higher and higher and higher in price because someone's willing to pay you more and more and more from it. The danger is when that ceases to be the case and trees don't grow to the sky. And at some point, those valuations start to go down. That has been the single biggest driving factor in your historic bear markets, is that move into, when the tailwinds from valuation expanding become headwinds and declining valuations. And that's something that we're very alive to at this point. Okay, great. Well, so here we just demonstrate kind of our thinking behind this, why we do believe that future interest rates will be lower. And this makes us sanguine as we hold on to bonds as the Fed is about to, let's say, begin this tightening cycle. And this is just one of the reasons. There's others that we'll explain, but we really wanted to demonstrate, in this case, this goes all the way back to 1980, shows 40 years, lower lows and lower highs of Fed interest rate hikes. And there was a lot that went on during those time periods, but I do believe that that imperative of kind of ever lower lows and highs will continue to hold in the future. And so right now there's some concern or a lot of speculation about how high the Fed might take rates. I think the answer is a lot lower than people think, in my opinion. Now, another point I wanted to make is that remember that the market is kind of constantly pricing in a whole host of things. To Kevin's point, it's a forward-looking mechanism, and so this demonstrates what we think is something very important. Also, when it comes to kind of thinking about bonds and their role in a diversified portfolio, and why we're willing to look past the recent kind of inflation history that we dealt with. Which is this. So this demonstrates what the market is already pricing in as short-term interest rates, the price to borrow money for 90 days, in December of 2024. And what the market has already priced in right now is 2%. So of course, the Fed hasn't even started raising rates yet. But the reason we wanted to highlight this is to demonstrate that, of course, the market is forward-looking, and that's where we have to live in as investors, is the future. And what we wanted to demonstrate with that red line that declines is that, as we've seen with frankly all these interest rate trends, that it's continued to have lower lows and lower highs. We think that is very fundamentally driven due to this over-indebted world and the need for kind of constant stimulus. So the chief takeaway when we put all these pieces together is that markets already kind of raised interest rates quite a bit, even though the Fed's done nothing. And so what that leads me to believe is that whatever damage or almost all the damage that was going to get done by this Fed rate hiking cycle, I think much of it has already occurred, according to these futures markets, in my opinion. Now, another way to think about this issue of of inflation, what our expectations are, what might happen in the future, is to ask yourself, well, what is the market already kind of pricing in? And do we agree or disagree with that? So that's really what we're getting at with this chart. So what the green line in this instance demonstrates is frankly a wonderful, useful market. I look at it daily. It's called the inflation protected market or the inflation break-even market. So this was an innovation that began in the US about 1998. And basically what it demonstrates is, again, every day, one of the things that the market is pricing in or demonstrating what its belief is what the market believes that the appropriate inflation expectation will be, or what inflation will be over the next 10 years. And what this chart demonstrates is that we've really kind of been between, say, 3% and 1% for the last 15 or 20 years. Of course, there was a huge crash into the COVID lockdowns and more of a normalization since then. But remember, the past CPI inflation that we've just had to deal with, the worst since 1980, we think due to these temporary, supply shocks and just the chaos of emerging from shutdowns, government mandated shutdowns, we're kind of back to 2%. Now, maybe the market's, wrong, and certainly it's been wrong in the past, but it's very insightful for us as investors to be able to look at this and kind of, we don't have to guess at it. We know exactly what the market thinks in this basis. I do believe that the short-term interest rate expectations are maybe a little higher. Zev, we were talking about what the 2 and 3 year expectations, what the market thought was the right number there.
Yeah, the 1 year break even is 3.5 right now, and the 2 year is 3.2.
Okay, well, so what the market believes or is pricing in right now is the right setup, is that we are winding down from a very meaningful and very real kind of shock in higher prices, but the market seems to believe that that's going to moderate. And I wouldn't disagree with the market's view on this. And the reason we wanted to highlight this is just that, with all this talk of inflation and so forth, the market is not pricing that in. The market does not believe that this is going to be the 70s. And in this instance, I do not disagree with it.
Louis, could you take just a moment, and while we talk about higher interest rates and the view that higher interest rates for longer is not sustainable, can you very simply explain the cost? If interest rates go from 2.5 to 4.5 or 5%, what that cost is, whether you're a small business, a large corporation, or the federal government?
Oh, sure. Well, that's a great question, Kevin. So the way to think about it, one of the most important prices in the world is the price to borrow money, because people operate with leverage. People have credit cards and they spend money they don't have. Businesses will accumulate inventory before a sale. A business will contract with a supplier to build a new plant before there's any revenue. So all of these things take borrowed money. And so the price of borrowing money is a hugely important fundamental factor in basically every economic decision that gets made in the planet. So when that short-term price of money is rising, it is unquestionably, slowing the kind of economy down, right? Because it's raising the cost of any kind of business activity you might want to do. And so this is why, if you go back, you look at the history of the last 40 years or so, kind of every, I suppose until the COVID crash, every slowdown had basically been caused by the Fed raising the price of money to such an extent that it caused a slowdown.
And to expand and explain to all of the investors on this call, the magnitude of the credit markets relative to equity markets. I think that's really important for people to understand just how much bigger the debt market is than the equity markets.
Yeah, no, that's an excellent point. Kevin, and frankly, one of the ways that we think about, we never buy a stock without examining, the debts of the capital structure. I mean, we really do think about the interplay of debt quite a bit. I mean, I did want to handle one kind of question, and this is kind of what might be our expectations about what rates might do in terms of how they interact, in terms of the typical pattern, as we were discussing with Kevin, is that the Fed does tend to raise the price of money at some point to an extent that it does choke off economic activity and kind of cause a recession. And so that's been the history of it. One thing also to kind of keep in mind, and I don't want to get too technical on this. There's no question there's a tremendous amount of money has been created, in terms of the Feds and this desperate attempt to try to buoy the economy after these COVID shocks. And that has created an enormous short-term stimulus and a tremendous amount of shortages. But again, I think if you take a look at the forward-looking markets, and we just described those, we just looked at those in the inflation-protected market, you are not seeing the kind of rolling inflation that would come to believe where that there's some kind of free fall in the value of money. And frankly, a lot of other markets aren't showing that as well. Now, let me make it very clear. We think for shortage issues, disruption issues, investment issues, we have a very optimistic view on, say, the future of commodity prices. But again, I don't really think that's necessarily inflation. I really feel, and frankly, we could do a whole market happy hour, a series of these things on debt dynamics. That over indebtedness, in my opinion, after studying this thing for decades, it's a very tricky concept to get right in my view, or at least to arrive at the framework that I have on this. But it is very much a simplifying factor, I think, that can help explain a lot of anomalous situations in the market. And so again, you say, well, CPI inflation 7%. How why are bonds not doing poorly? It's because they're looking ahead. They're doing an excellent job of pricing this. And the last thing I would say on this is just whatever 20 something years of experience in this, is that I have far more fundamental disagreements with what the equity market is doing at any point in time than I tend to do the bond market. And it's been my experience as a professional investor that whenever the bond market is materially has one view and the equity market has another, the bond market wins. And so one of the comments I've made many times in our investment meetings is that if I were teaching a class on cyclical forecasting, the bond market would be the star student, and the equity market would have a dunce cap and sit in the corner. The bond market just gets these things.
Louis, we have a few questions that have come in that I think are kind of timely to field right now. Going back to a previous slide, I wasn't able to get this in, but how does personal debt compare to federal debt with respect to debt burden? We discussed this during our warm-up session, actually. So Zeb, I think you might have an answer on this one.
Yeah. The total debt in the economy, everything included, federal, state, local, corporate, non-financial corporate, and personal is about 63 trillion versus about 29.5 federal. So, and then the personal component's about 18.
Mm-hmm.
So, the debt markets are huge, and Louis, or I guess it was you who asked. I mean, they're I think the S&P 500 is about 23 trillion total market cap, and of course there's a lot more stocks than just the S&P. So I don't know what the total stock market is.
But the debt's many times that.
Yeah, at least twice.
Okay.
And then another question that came in from Richard: about 25% of all dollars ever created were created in the past 18 months. What can the Fed do if they can't raise rates?
Yeah. Hey, Rich, thanks for your question. Yeah, that's an interesting question. Kind of, look, I mean, one of the reasons that we have a very constructive multi-decade view, frankly, kind of on commodities, is that we believe that these market forces are going to keep interest rates low. And because investors need to seek out yield and diversification, we think that this creates and will create, frankly, a multi-trillion-dollar bid that goes out into diversification instruments like gold, frankly, which of course has no credit risk in it. It has no yield, but many bonds also kind of have no yield, but gold is different because gold can't default on you as a lump of metal. So, I mean, I really think one of the things that's going to unfold in the next cycle, if I had to wear my forecasting hat, is that a greater sense the Fed not being the power behind the curtain. And Rich, I know you're a market historian, so you will appreciate this. One of the first and most interesting books I read on central banking, again, half my books back here is a book written by, I think it's Arthur Burns, and it's called The Anguish of Central Banking. And you should Google this, okay? So it's called The Anguish of Central Banking. And so it's not the unparalleled success of central banking, or it's not, Bernanke's memoirs or the memoirs of, Alan Greenspan. It's The Anguish of Central Banking. And it's a speech that Arthur Burns gave at, I think, a university in Czechoslovakia in 1979, as he was shown the door and Paul Volcker was coming in. And it's a really long treatise where Arthur Burns, who was the chairman of the Fed during the worst inflation, in American history, pretty much, basically says it wasn't my fault. So for 30 pages, he's like, it's not my fault, it's not my fault. But one of the things that he does make that I think is valid in that, Rich, is that he talks about the fact that there was no political will to stop inflation until, frankly, Carter was the one who hired Volcker. It was not Reagan. It was Carter that brought in Volcker in August of '79 to break the back of inflation. So what happened at that time, and again, I know you're a historian, so go back and read that, Anguish of Central Banking, Arthur Burns, is that the political will accumulated around the idea that inflation was the number one problem and had to be stopped. And frankly, the Fed did that once the political regime changed, that was bad. So I really think this issue of the political regime and what the Fed can do is going to become kind of highly problematic for them. And so I wouldn't be surprised if in the future, as the market is seen to dictate these things and the Fed has less ability to kind of create the outcome at once, I think its reputation is going to kind of go down a little bit. And so I'm in the Arthur Burns camp. So read that and tell me what you think, if you haven't already. So here we wanted to take, again, go a little bit different route and not look at so much the 70s, which we think is an inappropriate example in our opinion, but really look at the 40s. Because remember, the 40s were a different period where we were kind of working off the excesses, the Great Depression. Of course, we were rearming vigorously to fight a world war. Interest rates were exceptionally low and inflation was kind of high, and bonds kind of did fine. Yeah, it was kind of extraordinary, right? So here what we demonstrate is, I believe this was the 10-year interest rate in blue, I believe it is. That's correct. And you can see that was basically between, say, 3 and 2%, while CPI inflation was, as high as 15 to 20% during that time period. And one of the things, in my opinion, that was driving that, just the math of the situation, is that there were shortages, maybe not too different from COVID, because there was a war on, so you couldn't find sugar, you couldn't find coffee, bacon was hard to get. Cotton was on allocation. All these things were needed due to the war demand. So essentially, it was an extreme deglobalization event. It was an extreme fracturing of the supply chains, thought of in another way. And so the prices of all these things were up. But frankly, in this over-indebted world, interest rates could not and did not rise. And so I think that may be paradoxical for people whose only study of history kind of goes back to the 70s. There's a lot of history that precedes before that, and we think that's an example we're studying. Now, so we talked a little bit about inflation. We talked about equity valuation. Talked about say gold, the value diversification. We wanted to talk a little bit about things that may not be covered on the front page of CNBC or the Wall Street Journal or whatever, but that we think are important that we're monitoring. And the first and foremost of these, and we've talked about this for months, is what's going on in the Chinese real estate market. Remember, this is a $60 trillion asset class. You couldn't own a home in China in 1998. So they only had private property in terms of housing in 98. And they had an uninterrupted bull market for the last 30 years, more than 20, 25 years. Seemingly that's kind of over now, because basically we've talked about this for some time. The Chinese authorities in their wisdom decided to crack down on credit availability into the real estate market, which has resulted in a diversified index of US dollar denominated high yield bonds in China falling 50%, and in some cases 95% declines. So they've destroyed the ability of that industry to finance itself, and this has caused real estate activity to plummet. I think the square footage sold and so forth is down something like 20% year over year. So these are very, very meaningful declines in what is a $60 trillion asset class. Now, in my experience, you take a $60 trillion asset class and you, you throw some hurt on it, and the world's going to feel that. It's not going to be some corner in China is going to fester away. You're never going to hear about it. $60 trillion goes bad is a problem. So we're watching this with great interest. Number one. A couple of other things that we really think are kind of in line and maybe the deeper fundamental drivers to this disruption that we're all experiencing as consumers really has to do with these fracturing of supply chains. We've talked a lot about deglobalization, and frankly, war is the most extreme aspects of the deglobalizations, right? Because you're taking, at least in say the case of the modern economy right now, an economy that's been ever getting more integrated for the last 75 years or so, and now it's in small ways getting disintegrated. Of course, the COVID was a big shock on that, and we're all discovering, maybe to our horror, how closely intertwined all these economies were, and this is resulting in real increases in the cost of living. Now, I wanted to go back and talk about this environmental and social governance because, frankly, that's completely different and self-inflicted, and with real economic cost to real people. I don't want to debate the merits of focusing on climate change and so forth, but I think it's been disingenuous for people to push that line without underscoring that they're real costs. We're seeing these develop in Europe right now, and so the reason I'm highlighting, this greater architecture of social goals and so forth is that can create a gap in the period or a delay in how quickly the market can act as a problem-solving mechanism to put the resources in play to solve problems and to alleviate, high prices, which are shortages that need to be solved for us to move together, as a society. So I think as we are seeing, these ESG type mandates proliferate, I think that we are kind of sowing a decade of woe in front of us in terms of higher commodity prices. And we'll see how voters think about that when they're confronted with the reality of that, which I think may be a little different than what they were sold by their leaders or what people magically hoped would help otherwise. I think that's going to be a real issue. And of course, in my opinion, again, as a fiduciary and risk manager, the single biggest thing that risk I believe that we have to deal with is in the investment world is that we have these exceptionally high valuations that have been wonderful for us to enjoy on the front end. But how do we manage through that diversification aspect, try to do the best to shepherd our clients' wealth through what could be a very challenging period? This is what we're focused on as a research team. And of course, what this means in terms of proactive things that we can do, we like bonds. We like bonds. I mean, we think that rates are going to be a lot lower than people, think hopefully we've demonstrated through what's happened in the Eurodollar market is there's already been tremendous, increase in what the market believes will take place. We think this takes a lot of the sting out of anything that the Fed may do. And also we demonstrated hopefully the diversification impact of gold and gold related investments, which have, factored into our portfolios for a number of years that, that we think can be wonderful things to own at these times. And so when we think about our portfolios, we've done the best we can to kind of thoughtfully express these views, to be appropriately defensive, but to make it very clear that when we think about defensive investing, we don't mean hiding. We want to own things that are going to make money. That's our goal. And as the world changes, the scope of opportunities for us can change. And so if you think back to, say, the last couple of years, owning high quality bonds was longer dated high quality bonds was frankly a wonderful thing to do from 2018 until, the COVID dust settled. And then we had this explosive move and, certain equities. Now the equity leadership is moving. our job as a research team is to sift through these investment ideas and find them. So we just wanted to share with you that these are some of the things that that we're watching, and so we definitely take the inflation issue seriously, and I do bring some comfort from our multi-decade long study of that, and Zeb as well. But these are things that we kind of look through and think about.
Louis, I think that's an important part, as you discuss. We're not going to cash. We're not hiding at this point in time. There are investments out there that we find attractive. We discussed earlier about sort of demand elasticity. The amount of antibiotics that are going to be prescribed, right, will largely remain constant and perhaps growing. So there, areas like healthcare, more defensive arenas. We believe that protecting investors isn't just going to cash. It's going to be thoughtful deployment of their capital and changes to those investments.
No, that's a great summary, Kevin. That's exactly correct. Well, now, I think one of the things we wanted to do is we're kind of wrapping up the points that we wanted to highlight for people. So we've talked a lot about, why, even though the Fed hasn't yet started its rate hiking cycle, that, we have very fundamentally positive outlook on bonds. And of course, bond prices go up when bond yields go down. And so one of the things we demonstrate in this chart right now, this is a chart of 10-year bond yields, Chinese government bond yields. And what they demonstrate is at the lowest yield in a year. And remember, this is China that's been the source of 30 to 40% of incremental growth, all the incremental growth in the world in the last 10 years or so, 10, 15 years has been out of China. And so in many ways, I look at China for kind of the cyclical future of wherever we are, let's say, in the cycle. And frankly, their rates are low for the year. I wouldn't be surprised if before too long our interest rates are following their pattern. China's been such a huge source of incremental demand. And frankly, they are wrestling alligators with the real estate problems that they're having. Just one example, I think it was Monday that the government came out and cut interest rates for the first time in, I think, 2 or 3 years. And there was a press conference where the vice chairman or something noted that they were doing that to try, I'm trying to think what was the exact words, to avoid collapse in credit growth. And just when you're such a banker and you say you're cutting interest rates to avoid a collapse in credit growth, that's kind of bad. It's one of the things you want to be careful about. And so we have been talking about this issue of kind of a real estate slowdown in China. And frankly, I think that growth in many ways is going to be a struggle, which is one of the reasons that we do have this very fundamentally constructive outlook on bonds. But, we continue to, research and find, targeted equities that upon which we're bullish kind of every day. But we really wanted to show cyclically that this backdrop, it's, it might sound crazy to think that, interest rates could start going down, but realize that they're already doing that in China, and China is a huge part of world growth. So we're always on the lookout for things that may surprise consensus, and we certainly think this is one of them. So, we talked about a lot today. Everybody's been very patient. Thanks for taking the time. I just kind of summarized, hopefully we didn't put too many people to sleep with the scope of things we wanted to talk about. But to be really clear, long term, we are very constructive on commodity prices. We think they've been underinvested in. We think some of these ESG trends are favorable. And frankly, we think that parts of this deglobalization that's underway are also favorable for certain commodity prices. We have quite a bit of exposure to these areas. And we think it'll end up being higher at some point. But make no mistake, we really do believe that interest rates will be kind of lower for longer. And that frankly, we think through higher gold prices, that's part of our bullishness, structural bullishness on commodity prices. And finally, make no mistake that equity valuations are extended on a historic basis. And we believe as fiduciaries and risk managers, it's imperative for us to remain diversified, to be sensitive to valuation, and to really think about wealth preservation, because we have enjoyed so many fruits of expanding valuations to get to these incredible returns that Kevin was noting, 10 or 12-year bull market. But, these things don't last forever. And I think our job as risk managers and fiduciaries is to think about and prepare, for challenges that we might face on behalf of clients. So that's what we try to do every day.
Thank you, Lewis. I want to get to some of these questions before we run out of time here. We have a question from Vicky. With soaring corporate profits in oil, gas, and meat processing, how much does monopolization factor into inflation in some such sectors?
Oh, hi, Vicky. Thanks for your question. I suppose without getting too technical, I would argue, I suppose, that the greater profits on a sustainable basis are probably in the big tech companies that own platforms and they run monopoly businesses. But there's no question that we are seeing kind of a surge in profitability in some of those areas that you mentioned. Frankly, I tend to think about this very simplistically, in that there's a certain amount of economic return that companies that provide goods that people consume that are real, that they have to, these people have to have some kind of incentive. But I would be willing to bet you, Vicky, that if you go back, you look over a long period of time, that the profits that you note are highly cyclical. So for instance, the crude price was negative, a year and a half ago, and all these companies were kind of facing the prospect of bankruptcy. And certainly, I don't think they were very worried about their future. So unquestionably, they're benefiting right now in terms of cyclical uplift. But I would view that as a cyclical factor and not something that is monopolistic, because you have to have, the whole thing about monopoly is it has to endure for a long period of time. So I view that as more temporary.
And Lewis, to expand on that, is it safe to say that you typically see industry consolidation when corporate profits are falling and the industry is in despair? The airlines are a prime example of that, where you see quite a few of them going bankrupt, and that's when the consolidation, and it looks more monopolistic, not when the wind is in the sails of these businesses.
Yeah, no doubt. And I think, long sweep of all this, there was, I guess, Twain's, Gilded Age, kind of writing about, the excesses, the money concentration, and, kind of robber barons and, that kind of stuff. Frankly, that resides in tech right now, given these multi-trillion-dollar valuations of these huge platform companies. Typically the forces of creative destruction and cyclical up cycles and down cycles, make it a challenge for companies to establish any kind of high sustainable return on equity. And so I think, our challenge as investors is to try to figure out when the returns are real and when they're sustainable, which is probably the hardest part of this business, in my opinion.
Yeah, meat processing is a problem business from a monopoly standpoint, but probably like Lewis said, certainly not as bad as Twitter.
All right, Lewis, we have another question from Dennis and Suzanne. Has the world ever experienced the debt level we now have, and aren't we in a new dimension of expectations?
The answer is no,
Yes.
we have never experienced it. And yes, we are all experiencing this new. If you go back and you look, hopefully some of you on this call may have experienced, what was kind of been the highlight of my experience in doing these. Of course, we had the great bond investment guru, in my opinion, Lacey Hunt. And remember Lacey's charts at Hoisington in his quarterly piece are must read as far as I'm concerned. And so to answer your question, I'm thinking back about a chart that can be found there in Lacey's work. And what he's demonstrated is debt to GDP going back, I want to say it's like 1900. And so this was, I think, total debt to GDP. It was about 200% debt to GDP, which was really the credit-driven boom. This is into, let's say, 1928 or so. And then, of course, GDP collapsed in 29 and 30 and 31. So that debt to GDP went from 200% to 250%, peaked at 250% during the Depression. And then it fell from 250% in 1931 or 2 until 50% in 1946. And so during the war, with high savings and inflation and not a lot of consumption, and people that frankly were terrified because they lived through the worst economic cataclysm in history, people saved reduced debt of 200% GDP. And so debts were down to 50% of GDP. And so, yeah, there was this brief time period. Of course, debts, I think US debt to GDP is probably 50% higher now than that old peak. But that debt-driven boom was, of course, a wonderful thing to live through on the front end, and it was, terrifying on the back end. And so, frankly, one of the things, so we are in unprecedented periods, at least in terms of the U.S. I do believe there is, however, insight to be learned from studying Japan. Remember, Japanese debt to GDP, sovereign debt to GDP is like 3 to 4 times higher than ours, and their interest rates are lower. But basically, I think when the history, and this is a controversial view, when the history of this period gets written 20 or 30 or 40 years from now, it will be very damning about the activity of central bankers who let this ecosystem of debts proliferate way beyond historic levels. I think there was historically a limiting level why rates, while indebtedness never got this high, because the markets were allowed to function and the markets never let it happen. But under central bank leadership of the US Fed and frankly, central banks globally, this ecosystem of debt has been allowed to proliferate. And how they manage that and working that down is going to be the single biggest important issue for our economic future. And there's a lot of uncertainty how that's going to act. But I do think that history will not be kind when it goes back and it looks at the role that these people have played for decades in creating this debt-driven system that is so fragmented. And the last thing I guess I would say on this one point is, look at the financial history for the last 20 years. 87 crash, you had 98 Asian crisis, then you had tech bubble, housing bubble, and now whatever it is that we're dealing with now at the highest valuations ever. It's a serial creation of asset bubbles financed by the proliferation of debts. And this is creating enormous volatility. It's creating enormous wealth inequality. So we've got equity markets at all-time high, and we have people that hate each other in terms of social polarity and cohesiveness. It's very complex, and I think it is problematic. And so we try to study history to gauge a way forward in this, and we've done that to the greatest extent possible. But it is in uncharted territory.
Louis, we have time for one more question from Jeff. Can unforeseen geopolitical events have an impact on tipping short-term inflation and long-term inflation patterns? Say Russia invades and absorbs Ukraine during 2022 as the unforeseen event.
Yeah,
Jeff, you were just talking about this earlier.
Yeah, hi Jeff. Thanks for your question. Yeah, we were just talking about this earlier. And so maybe just to frame this a little bit, when we were talking about it earlier, I was expressing war as a kind of extreme deglobalization, right? Because I don't know if you're invading somebody or if they certainly become the enemy, but they're now in armed conflict with you, you're probably not buying stuff from them. Any kind of loans that you had into that are probably gone. Your combatants, that's a very different world than we've lived in for the last, 75 years, since the last global conflagration, the end of World War II. But I really would encourage a lot of people to think about, these price surges that we've all seen, really more deglobalization, supply chain driven. But frankly, those are very real. It's just going to have a very different, impact. So it means different assets are going to benefit and suffer than, say, a traditional definition of inflation. But yeah, I think if you take a look at war historically has been highly inflationary. And frankly, one of the things that's funny that you were asking this, one of the things that we were discussing as a group, not 2 hours ago, was really that very, very big picture that, when the US fought a world war and we set up a system, UN, WTO, a rules-based system that was there to kind of enshrine us at the top. And that's kind of not as good as it was anymore. It's kind of weakening around the edges. And that's kind of, in my opinion, it's not good for us. But one of the risks that we face is as economic aspects of deglobalization are breaking out, war is just simply a more aggressive form of deglobalization. So I suppose at some point we could see more of a shock to cost of living, say higher commodity prices, different kind of scarcity, things that we've seen so far. But again, I would just highlight that in terms of financial aspects, that don't think for a second that that means like you have the 70s. You know, history suggests many different outcomes are different, and we would suggest that the example of the 40s may be more appropriate.
Thank you, Louis. I think we all appreciate that. Thank you all for joining us this evening, and any questions that we did not get to, we will be sure to respond. And we look forward to seeing all of you at the next Market Happy Hour.
Oh, thanks. And the last thing I would say is please take the time to take a look and give us any kind of feedback. You know, we read all the comments, even the ones that tell us how we need to improve, because we really want to commit to having these be useful for us. So please be brutal. Let us know what you think.
Thank you all. Have a great night.
Thanks.
Bye-bye.